Somebody's not speeding into the open because we are seeing stocks that look like they're going to open a little bit lower here this morning. And our opening bell coverage is sponsored by FlexShares here as we take a look at the opening prices on this Thursday morning. Always takes me a minute to remember which
Friday's Eve here.
It is a Friday Eve, as we like to call it around here. So if you look at what's going on with stocks here this morning and where we have opened, a little bit of pressure. I have continued to be watching what we are hearing from the ECB and kind of how the coordinated central bank tightening is taking effect around the world. Of course, the ECB's tightening is not coming quite yet. Mm-hmm. They are saying it's going to be starting in July and then will continue thereafter. But of course, one of the main tools of central banks is not just when they actually change rates. Mm-hmm. It's the telegraphing and the effect that that has on sentiment, and then also can serve as a lever to change rates without them actually doing anything.
I keep living in my alternate reality. We've seen this happen before. It's like the consumer is under pressure. You see companies like Signet, you see Five Below, they're telling you consumer spending is slowing down. Then you have central banks around the world lifting interest rates, and it's just, you could just see the slowdown coming, and you could just probably see more pressure on the stock market.
Right. You're getting
I'm not calling this. You could just see these things potentially happening.
Well, in terms of the behavioral spending that we're seeing right now, it's leaning more into bulk. It's also having to incur higher prices at the pump just to get to work, just to pick up the kids from school. And so all of those things factored in, households across the board are trimming what we've seen over the course of this retail season, their discretionary spending. And albeit this is during a summer season, too, where a lot of that money is already earmarked, perhaps, for vacations, should you still be taking them, and should you see higher ticket prices along that vacation. So it's kind of hedging against how much you're already anticipating spending when you do travel, plus gearing up for the rest of the summer and even beyond that going into the back-to-school season so that, you're not in the red across the board at your household.
To be clear, the Fed wants this to happen to some degree. That's how you get.
A little frightening for the bulls.
But that's how it works. Their mandate is not economic growth. Mm-hmm. To be clear, mm-hmm. Their mandate is not GDP. Mm-hmm. Their mandate is price stability and employment growth.
So
right?
They're willing to live with a potential recession.
That's how it works. No, they're not willing to live with a potential recession. They are reacting to the factors on the ground right now. Mm-hmm. That's the reality of the situation. That's how it works. There's inflation. Imagine if you would, if the Fed stopped right now. If at the next meeting they said, we're not going to raise rates anymore. They literally cannot. They're put in a situation where they really can't do that. Unless growth is not negative, right? Right. While headline inflation is 8%, while we are not seeing significant slowing, they cannot stop. It's not within their purview.
That's why I do think your investors are going into one of the most challenging periods a lot of them have ever been through outside of the Great Recession. And it's very hard to find. I mean, I hear all the strategists telling about look for good free cash flow. I get it, but still, what does that free cash flow look like in a world that is slowing down and there's a higher cost of capital, and you see the stock market still not really reflecting any of these things?
I guess my question on top of it, though, would be for the goal still being full employment, if we do see even more hiring cuts, if we do see kind of a right sizing that companies are going through with regard to the amount of people that they have underneath of their headcount for the projects that they're earmarking, not just for the next year or for 2 years, but for the next 3 to 5 years even. And how does that kind of put a dampener on where people are willing to spend if you don't have that same negotiating power when you are even getting into a good job?